This podcast is proudly brought to you by Term Plus. What I like about Term Plus is its easy to use online platform, giving you access to high-yield term-based accounts, providing consistent monthly income. Owned and operated by Pengana, an ASX-listed company with 23 years of experience, Term Plus is democratizing access to global private credit markets. Visit termplus.com.au to learn more and read the PDS before investing. I'm proud to say that this Rask podcast episode is brought to you by PIMCO, one of the world's leading fixed income investment managers. With more than 50 years of experience in navigating complex global markets, trillions of dollars under management, and a global team of experts, PIMCO is a name trusted by investors worldwide. Discover how PIMCO can help you build a more resilient portfolio at pimco.com/au. Hey Kanish, how you doing?
Not bad, Owen. How are you?
Pretty good, mate. It's always good to chat to you. So, especially about topics like we're going to talk about today, because it's actionable for people, retirees, accumulators, capital allocators, everyone can get something from today's episode, because we're talking about hybrid securities. We're talking about fixed income, credit, everything that's in that spectrum of defense and also defensive alts and income. So we're going to cover all that terrain. Obviously, you've been on the show a lot. People know you from your own work. Tally, you're saying that kids recognize you from the TV. They're like, hey, that's Dad up there. But it's great to just do this with you. So if people want to, they can refer back to other episodes where we've talked about different things, including some of the ETFs that PIMCO has to offer. One of the things that I kind of joke about, and we joked off air, is, what are hybrid securities is probably a great question for anyone, but also for people that hold them, because a lot of them don't understand truly what they are. So I wanted to start at the absolute basics. Don't leave anyone behind, Kanish. Like, what are hybrid securities?
Yeah, so I think we've spoken about this before, that the financial world loves different terminology, different acronyms. ETFs is one example of that. I was speaking to a really good friend of mine, Annika, and I asked her, because I've got a lot of friends that aren't in finance, so I sometimes use them as a bit of a sounding board. And before this episode, I asked them, by the way, do you know what a hybrid is? And the response was, oh, isn't that like the hybrid vehicle, like the car? And I was like, okay, good. It's not. And effectively, a hybrid security is a financial instrument that is part bond, part equity. So it's part bond, part share.
Yep.
So the best way to think about this is, and this is the ASX definition, because I want to make sure I get this right from how the ASX has referred to them, is it's an instrument that combines elements of debt and equity, and they typically offer a fixed or floating rate of return until a certain date, so until a maturity date.
Yep. And
at which point that particular hybrid security, or a tier one, is the other terminology that it may get referred to here, gets called or matures.
Yep.
Effectively. So it's very similar to a bond or a debt security, but however, it carries a lot of equity-like features. It's listed. It's generally got some element of potential conversion into an equity share as well. And what we've seen in Australia is a lot of corporates, primarily banks and financial institutions, have listed hybrids and issued hybrids as a way of raising capital. Now, within that hybrid structure, obviously, you think about the capital structure. And the ASX has a really good example of this. But you've got cash, you've got bonds, you've got hybrids, and then you've got equity. And that's in terms of that risk return profile. So the hybrids are part bond, part equity. They allocate, or they have allocated to them, a higher level of risk, which obviously allows them to have a slightly higher relative element of return compared to, say, just typical cash or a bond that would be issued by the same financial institution or bank.
Yeah. So you mentioned a phrase there, which is pretty common for people that study banks, as in like bank shares or just banks globally. Was it AT1?
AT1s, yeah.
And that's...
Or tier one securities.
Yeah, tier one securities, because that's in reference to the banks having to hold a certain amount of capital on their balance sheet for protections of downturns or credit issues and that sort of thing, right?
Effectively, yes. Yeah. So within the banks, there's a capital structure, and they have to hold sort of their capital within, and in terms of what they issue out.
Yep. And
there's restrictions around that as well.
Yep.
So they've got to be within that sort of allocation from that cap structure perspective. The other thing is, we've seen that hybrid market reached upwards of about 50 billion Australian dollars here in the market here in Australia.
Yep.
And this, by the way, is not just an Australian market. It's not an Australian vehicle that only Australians get offered. In Europe, the tier one market or the hybrid market is really large. It's really sort of widely popular, in particular a lot across institutions and wholesale investors.
Okay.
Here in Australia, it was unique in the sense that it was offered to retail investors as well.
Yep.
And I think one of the unique points here was very popular with retirees because the hybrid securities generally were offered by financial institutions and banks. Being that part bond, part equity, there was quite a good element of income and franking credits that were offered as part of those issuances. So they feature and have featured in a lot of portfolios, but probably that inherent level potential risk that could occur, given that they've got some equity-like features. And we haven't really seen some of those being tested out in the market per se in a local context. And a lot of the banks that have offered them are, very well-known, large, big four institutions.
So for people that aren't familiar or haven't heard the news, bank hybrids in Australia are being phased out by APRA, which is the regulator, by 2032. So I guess there's two questions here is why and where does that leave bank hybrid investors? So if I'm sitting here watching this, listening to this, a lot of retirees would hold these in particular, singling them out. Where does that leave those investors?
Yes. So effectively, at last check, I think there was about $42 billion in bank hybrids that were available. The last bank hybrid that will be allowed to, or that will be closed is in 2032.
Right.
And there is a point in which no more bank hybrids can be issued out as well. So APRA has basically come out after an 18-month review and consultation with various market participants and looking offshore as well. They've decided to phase out this hybrid market. Now, the fundamental reason for that was this is from APRA, is to reduce that systemic risk and strengthen what they believe is the bank resiliency in their capital structure. So that's fundamentally their reasoning behind it. Obviously, the simplification of those capital structures. So if we look at this, their preference has been, when I think about it, is a shift towards a simpler, a more transparent capital structure from a bank perspective. There's an element there also from how they saw it, and we talked about retirees, being quite heavily invested into hybrids and retail investors. It's a listed vehicle. Anyone can buy and sell these hybrids. Over 50% of the hybrid market or hybrid investors were retail investors. Okay. So from their perspective, they felt there was some level of protectionism or protection mechanisms that they wanted to put into place. And that was also one of the reasons why they thought that it would be best to phase out the hybrid market. Now, that effectively means no more hybrids. 2032 is your last call. Over that period, there are different hybrids from, and it's only real financial bank hybrids that are being phased out. So corporations, insurance companies can still issue hybrids, should they want. So there is still some hybrid market there. But as I said, majority of the hybrid market has been very much dominated by the financial institutions. Any hybrids that effectively at their first call, that's when they effectively now mature. Okay. So previously, that hybrid security could have gotten rolled over for another date. That can't happen. So the first call, the first maturity call, effectively, that hybrid will get turned off and monies will be returned to the investors. So we're obviously seeing, some people that have gone and actively sold out their hybrid investments. Some are holding on to that, given there's still that yield element that they're receiving and the franking credits, et cetera, that they're receiving.
So that basically, in a sense, there's like 6 or so years for people to redeploy capital, whether they like it or not. That's coming. So the RBA recently cut rates. Expectations are that rates will also may even come down in the near term. Like, we don't know. That's just expectations. But how does that affect hybrids, generally speaking?
Well, when you think about it, the hybrids are predominantly a mix of fixed and floating, majority of floating rate components to it. So in a floating rate environment, in terms of the underlying the hybrids, if you have a rate environment that is coming down, the income that is being produced by those hybrids will naturally come down.
Yeah.
And so that's generally you're going to see that tendency to come down as well.
Yeah. What about then? So I noticed there was a blog post that you guys put out, which I can link to. And it said, this is a really interesting thing. I'll quote, an analysis of 38 hybrid securities with an average call date in 3.5 years reveals current returns of 7.4%. However, the easy yields are expected to decline to around 6.7% over the next 3 to 5 years as cash rates fall. So, as you said, floating rate. So it seems that its rates will affect the hybrid securities as well. So you're going to see lower expected returns.
The APRA decision came out late 2024. There was some rumors as to what was going to happen prior to that, and effectively late 2024, that was their decision that came out and it was announced publicly. A lot of clients were coming out to us and asking, what should we do? And that still, by the way, is still a very common question when I go out and talk to financial advisor clients. How should we approach this phase out of hybrids? Just because, we've seen from the financial bank institution hybrids this year, we've seen 2 to 3 already mature. We've got quite a large one that's about a $1.7, $1.8 billion hybrid security that will be maturing in September. There's another $500 to $600 million hybrid security that's maturing in December. So a lot of financial advisor clients, a lot of stockbrokers, a lot of private wealth advisor clients are saying, well, we're getting questions from our clients. What do we do now? How do we approach this? And so we, what I noticed and what was said to me as well by clients was, we're getting bombarded with this particular fund or this, new listed structure or whatever it may be. And we wanted to take that approach and, take a bit of a step back and go, there has to be an alternate approach to this. And so that's that blog post that you're referring to. We've got a team here at PIMCO. It's our Client Solutions and Analytics team, or CSNA is what we call it. It's basically our portfolio modeling team and risk assessment team. And we were able to leverage that team to allow them to really deep dive on the hybrid market and analyze what would happen in this market. What is that risk return profile that a Australian hybrid investor is now trying to replace? And in that context, there was that stat that came out that when we did that analysis of those 38 hybrids, in a falling rate environment over the next 3.5 years, there is that expectation that yields will come down to around that 6.7%.
Because people are facing this in many ways, right? It's not just hybrids.
No.
It's like term deposits, cash savings accounts. A lot of end investors are thinking, well, where am I going to get that income?
Yes.
So we don't have to go that far back in history pre-COVID to know that rates on TDs or term deposits were 1% to 2%, right? And that was pretty shocking for a lot of retirees at the time, and a lot of people that have savings, right? It effectively is harsh on savers. But one thing that people should understand, and people listening, is that it's not all bad, because as rates move around, as things change, there's opportunities that present themselves. So my question to you is going to be, should people be exploring those other options now? If they've got hybrids, say, for example, should they be exploring them now?
I would say yes. And I only say that because of this reason. So you think about, and I think we've spoken on this in one of the previous episodes, what happens to a bond when interest rates fall? Now, the price of the bond actually goes up. So there's that inverse relationship that occurs. The price of the bond goes up depending upon the type of bond that it is. So if you've got a bond that has been locked in to pay a percentage rate at this point in time in over 10 years, and it expires in 10 years' time, and that's that fixed bond pays, say, let's call it 5%. Now, if the interest rate is starting to come down, that bond, the premium that bond now attracts, because it's still paying 5%, becomes higher. So the price of that bond appreciates. Now, if that bond was a floating rate bond, well, then that would have its own determinations on the price, because then that moves in sort of a particular lockstep with where rates are at that point. So that's the difference between that fixed and floating. And so from that perspective, what we found there was, in the situation with, where we look at our fixed income portfolios and where we see potential, there is a potential for, and this is where a lot of people have looked at the bond markets and started to return, and fixed income investing really has become a much more of a common conversation, I would say, than previously in the past, 3, 4, 5, 6 years because of the rate environment that we're in at the moment. The rate environment where there is some element of peak rates that have occurred and the rates are starting to decline, we are starting to see a potential for benefits and opportunity that exists within the fixed income market from an active perspective.
Because one of the things that I see a lot, Kanish, is that in our investment community at least, and amongst some newer investors that are talking about bonds for the first time, talking about fixed rate securities. So they're not only unfamiliar because of pre-COVID, there wasn't much on offer from a yield perspective, but more recently, as rates went up as a result of COVID afterwards, they saw those the bond ETFs, the bond funds, like really not deliver for them, like negative returns, sometimes double digits. And so they're thinking, well, why on earth would you invest in a bond fund, right? A bond ETF. Like, why would you do that? But as you were just alluding to, it's not, you benefit from the reversal of that potentially, the capital uplift, but also the increased income that those new bonds coming into the ETFs and into the funds are kind of being swallowed in, and they're yielding more, right?
Yeah, exactly right. So in that high yield environment, the bonds would be yielding higher. And then in a period where interest rates are falling, those bonds appreciate from a price capital perspective. So the yields are there, and then you're also getting an uplift of the price appreciation. 2022 was a unique year in which we saw a real sort of, a real quick action by a lot of central banks, some would say too quick, to counter that inflationary pressures that existed in the market, where we saw this rapid rate rise environment. Yeah. And so from that perspective, in that situation, yes, a rising rate hurt bond prices. So you saw in such a rapid acceleration, which we hadn't seen before. Yeah. It was one of those unique moments from a financial market history where students will look back and go, what occurred and why did this occur? Is because of that, where rates rose so rapidly, bond prices depreciated accordingly. And because they're coming from that lower base already from a yield perspective, there was that pressure that a lot of portfolios were under from a bond perspective. I think where we're at now is that different market environment. And what we're looking at from a rate perspective is we are seeing rates gradually come down across all the different central banks. Some have been a little bit more aggressive than others. Some are taking their time. But overall, there is a neutral rate that we see central banks needing to get to. Each central bank has their own sort of neutral rate. And we do see a bit more of a patient approach to that occurring at the moment, given especially the geopolitics and other volatility that exists in the market.
Yeah, yeah. One of the things that's always kind of I found a little bit interesting about hybrids, if we just come back to that for a second, is the fact that I remember reading like the disclosure documents, and some of them were over 100 pages. And I always thought to myself, these don't seem to be really understandable from an everyday investor perspective. Like, I get a lease document for an office in our business, and it's 35 pages, and I start to sweat. So, and I kind of do this thing for a living. So,
and there's no ChatGPT.
There was none. So, no way to easy just kind of use AI for this. But if we think about hybrids offering, say, 6 to 7% as a return profile, what are the alternatives to that? Now, obviously, we're here today in the PIMCO offices. We're talking about this because I hope you can illuminate us on that, because I feel like there are alternatives. But maybe if we tackle that from not just the return profile perspective, but also the risk perspective, that would be really helpful.
Yeah, so I think about those hybrids in that capital structure example that we talked about. So you've got cash, you've got bonds, you've got hybrids, and then you've got equities. Yeah. So hybrids generally were seen and are in that capital structure, slightly higher risk, but have offered that higher element of return. Yeah. So when we looked at this analysis and the hybrid matching of how we looked at this is as at the 30th of April, 2025. So obviously this may have changed some of this data.
Yeah, for sure.
But as of the 30th of April, the estimated return that we were trying to match to replace a hybrid portfolio was 6.7%. So that estimated return was about 6.7%. When we then combined a combination of core bond funds, cash funds or cash bond funds, so more shorter duration style funds, and then also some of the high yielding, higher risk private credit strategies as well. And there is a bit of a complex sort of, complementary nature to this. We talk about diversification always, and this is where we've come from, is there has to be a diversified multi-product approach if you want to replace one for one. So there's no apple-to-apple replacement for a hybrid, unfortunately. Right. I think
they're very unique.
And no one can say that, because when you apply the risk profile to achieve a 6.77% return, there is going to be some element of risk that you're associating to that.
Yep.
So how we looked at it was actually, if you complement a various range of different private and public fixed income strategies, we were able to achieve that same 6.7% return. Obviously, there's no franking in this return as well, but also for about 20% less volatility,
right,
than what a hybrid portfolio or hybrid security would return as well. So that's the other thing, is that hybrid security has a volatility associated to it. It's a listed product. It's determined, its price is determined by the buyers and sellers of that particular strategy. Supply and demand, it goes up and down like a share. And so how we looked at it was, 20% in core bonds, 10% in sort of an enhanced cash solution, 30% in a global multi-sector income solution, 25% in global diversified private credit model, and 10% in global hybrid security portfolios. I think taking a step back, if I looked at PIMCO actually manages over $5 billion US in a global hybrid portfolio.
Oh, right.
So hybrids is not just unique to Australia. As mentioned, it's available in Europe, and by many of the institutions in Europe do use and hybrids as a way to raise capital.
Yep.
And so we actually are quite well known within this space, but from a global perspective.
Yep.
So combining all of those together, we effectively were able to return what is a return of about 6.7%. So we've matched that hybrid portfolio effectively. But I guess the real answer there is we're trying to provide a solution to replace one, and it has to be from a diversified approach to match or lower that level of risk that you are trying to inbuild into the portfolio and achieve that return.
So effectively, you've matched the return, but lower risk.
Lowered the risk, yes.
Yeah. Okay, and it's interesting because a lot of what we're hearing on this podcast, but also just in general in the investment community, is that there is that kind of, here's like, you've got a hybrid security, you've got these yielding whatever they're yielding. Here, take this, it's exactly the same. But you're suggesting that, well, maybe to lower the risk while you're doing that, have that diversified approach, get exposure to different asset classes within this whole realm of fixed income.
Exactly right. Yeah, and I think fixed income, from a listed perspective, from an ETF perspective, from a PIMCO side, we only just launched ETFs here in the market. When I looked at the ETF market with over 400 products in ETFs, there's still a very large majority of equity-focused ETFs still. So the fixed income world is still very new to a lot of investors.
Yeah.
And so from that perspective, people need to sort of peel that onion back a few times to understand that there's more to fixed income in terms of those different strategies that can blend together to be able to, in the same way you would for an equity portfolio.
Yeah. So one of the things that I read in this report was that the PIMCO website says 25% of the hybrid market, only 25% needs to go to illiquid assets, while the remainder can go into bonds. It's interesting because I'm speaking to a lot of investors, and they're going into like extremely illiquid assets, and that kind of, I get that some of it may be warranted, but it seems like people, at least retail investors or even the sophisticated investors that are unadvised, are taking on way more risk into these like locked up funds or things that they truly don't understand yet again.
Yes.
And that kind of makes it a little bit concerning for me. But this is reassuring if people think about that as kind of like a yardstick. Well, you're telling us that there's heaps of opportunities available where you have maybe like even an ETF structure or a fund structure, a traditional fund structure, which is, if not daily liquid, maybe monthly or quarterly liquid. You don't have to necessarily have everything locked up as the alternative.
No, and I think that's what we're seeing is there's a bit of an evolution in that private credit area of fixed income or of asset management here in Australia, born by, and brought by a lot of domestic players, but also global players. PIMCO is one of them. We have a large private credit suite as well that we offer to clients, but it is offered under the guise, and obviously for sophisticated investors, for investors that appreciate and understand the illiquidity premia that you're receiving for investing in that particular strategy.
Yeah.
And so from that perspective, we're not to say, let's take all of this and put it into one private credit strategy. No, that's not the right approach, because there's elements of illiquidity there. There's elements of higher risk there. Even if the potential could be higher returns, you're going to be, for that higher return, you're taking on some level of risk. That's just the nature of it. And so how we saw that was you could have a portion in private credit, or semi-liquid private credit is how we looked at it, combining with, other core fixed income focused fixed income, or even looking at sort of those enhanced cash style strategies as well.
Yeah. So you've got the 4 ETFs already in market here. Can you give us an example or two of where the yields on those funds might be? Like, I know it's at the time of recording. Recording's the 27th of August, 2025. And things change from time to time. But I would just be really curious for people. And for disclosure, Rask is actually an investor in 2 PIMCO funds, just for full disclosure. So if you could give us a sense of where that's at.
Yeah, definitely. So if I looked at it as at the 31st of July, 2025, so I'm using end of July numbers here, the total carry yield to maturity for, say, our global bond fund, or a global bond active ETF, which is PGBF, is 6.19%.
Right.
Our Australian bond fund, which is PAUS, or the PIMCO Global Australian Bond Active ETF, is 5.33 from a total carry perspective. So that, obviously, from how we've looked at it, it's there's an element of active approach to this as well. So we actively manage these strategies in terms of the duration, so how much duration we want, risk. So that interest rate risk is that duration, how much risk we want to take, where we want to sit from a credit perspective, which underlying strategies we want to, or exposures we want to take. And in the global, do you go more into the US? Do you take an underweight to the US? Do you go more into Australia? All those different facets feature into these portfolios from an active perspective. Yeah,
and we've talked about the process before, and the top-down, bottom-up combination. I think it's worth mentioning before, because you did make a remark, and this is for anyone that may be hearing you for the first time, or even maybe PIMCO is a new name to you. PIMCO's been around for a very, very long time, and is one of the biggest in the world at doing this. But the ETFs are new, but the underlying strategies have been in place for quite some time.
Yes.
So I think that's important to recognize. The ETFs are just a vehicle, a way in and out of the funds that were already there effectively.
Yes. Yeah, a good example is that global bond active ETF, so PGBF. So that strategy effectively feeds into our Australian vehicle for the global bond strategy, which has about 8 billion Australian dollars underneath it. But globally, that strategy, I think it's over about 100 billion US. That is managed within that strategy. So these are very large underlying strategies that we manage on behalf of investors, both retail, wholesale, and institutional investors. There's a whole range of institutional investors that are utilizing our funds within this space.
So I think that's just a good call out, because for folks that if I was in this situation where I held hybrids, we actually, in our portfolios, we got rid of them a couple of years ago.
Okay. And what was the reason for that?
I think that, because rates had come back. It was time to spin out of hybrids. But to be honest, also, I think, maybe I don't know, maybe this is a bit feisty to say on the podcast, but I also saw some underlying risk with some of the banks at the time of COVID. And I think it just gave me a new appreciation for what we do and don't own. And to be honest, I just wanted higher quality, higher grade exposure to reliable income sources. And so with rates the way they are now, saw the opportunity to move into what the bonds that were previously unloved were come back. And I was really excited about that. So I think for people that are building a retirement portfolio from scratch, or if you're in a situation where you can start afresh because hybrids are rolling off and that, I think it's actually right now is a wonderful time to be building that part of a portfolio. I think it's probably one of the best I've seen in quite a while.
Yeah, and I think what I'm trying to see a bit more of at the moment is there is more conversation on fixed income. Obviously, we talk primarily to that advice community and that financial professional community. There has definitely been a pickup in interest, in conversation around public fixed income, so core bond strategies. Private credit obviously has picked up, just given the media around that and sort of the promotion that's happened as well. But that's, I think, will gradually flow through to everyday investors, where, we've got a diversified fixed interest fund in an ETF form, PDFI. That's effectively that 50% Aussie, bond active ETF and 50% global bond fund.
Simple.
So very simple, one-stop shop. It allows investors to take that really true diversified approach for their fixed income allocation. So it's one of those solutions where, unique to the market, we want to offer to everyone to say that if they want diversification, there's optionality there. And to that point, there wasn't that, years ago.
I find in investing, when there's an artificial deadline, so something like maybe inheritance, maybe it's retirement, maybe it's hybrids rolling off, just something that pops up, it's kind of like catches you off guard. It's not necessarily artificial in some instances, but it gives you a pause for thought, and you think, where can I redeploy this capital? And some people might be tempted to, I guess, go from a hybrid security 6 to 7%, and they see some other flashing lights with maybe high single digits. What caution would you issue to people that maybe get drawn into those really, on the surface, it seemed like really compelling rates? I'm seeing a lot of that in unlisted funds and in private credit, I must say. So what caution would you issue to them, or what would you say to be mindful of?
Yeah, look, I had a friend of mine the other day mentioned to me about a private credit fund that they've been allocating to, and I have just asked, have you checked? Do you understand the lockups? Do you understand the risk involved? And do you understand the underlying investment? And as long as you're doing your research, you speak to a financial professional, if that's, how you're taking your advice, which you should be, you need to be asking those questions. Like we've said this before, I wouldn't want anyone to come into any of the PIMCO ETFs without doing their research.
Yeah, for sure.
Do your research, come to us as the issuer, talk to us, look at the prospectus, speak to an advisor, do all of those things, because you should be doing that anyway.
Yeah.
At a sort of
minimum.
At a minimum.
Yeah.
And with private credit, given we know that there is some illiquidity in them in terms of those lockups, that's fine. And as long as you're walking in knowing that. And so where I've actually seen a lot of advisors look to allocate to private credit has been where portfolios are generally a little bit larger, where their ability to take on more risk and take on that lack of liquidity, where they don't need that portion of cash immediately and they're happy to have it locked up for 3 months or even longer. For some of those really bespoke private credit strategies, it could be 2-3 years, for example. And so as long as people are aware of that, they're going to potentially get a higher return, but also there's a higher level of risk as well associated to that.
Yeah, true. I think that's really sage wisdom there, because like reading the PDS, if it's available, not always available, if it's a wholesale fund, is also important to understand for folks. But because these are in ETF vehicles, I think that it's easier for people to navigate, because you do have a super high quality, reputable fund manager that's also listed its funds. So the ability to sell is available to you. So I think that's a really important feature.
Yes.
And it shouldn't be underestimated.
And I think it's really important to understand a listed investment trust and an ETF are two different things.
Totally different.
They operate, maybe that's a whole new episode. But and maybe you've done that already. And if you have, make sure you have a listen to it, because it is two very different things. The way in which they're priced, the liquidity on them. As I said, within our ETFs for our core bond strategies that we've launched, they're liquid in their nature. They allow, we have ability for people to buy and sell. They fit into very large strategies. But also, read the PDS, do your research.
Read the PDS, definitely.
Give PIMCO a call.
Yeah, definitely. So I've just got one final question to you, but I'll put a link in the show notes to the blog post that was put up by PIMCO, because it's probably the most illuminating on the risk return spectrum. And I just want people to remember what you've kind of put in their minds, which is, imagine that risk return kind of line is going cash, bonds, hybrids. In this case, we're talking about hybrids.
Yep.
And then up to shares or equities at the top.
Yes.
Imagine that curve or that line going up the page. But I like to tell people to subscribe to 5 fund managers, or to at least read them regularly, visit their websites before making portfolio decisions. So if you're interested in global shares, go and subscribe to 5 global share investors and their monthly letters, or same with fixed income. Do you have any resources, or can you point people to anything that would help them understand this part of the world? Because we're going to have a lot of investors rolling out of hybrids now and looking for places to get income.
Yep.
I'm just curious, like, would there be anywhere that you would direct them?
Yeah. So, from a PIMCO perspective, we do a lot of content. Sometimes there's just so much that we have.
Yeah.
A lot of it's also very macro orientated. So, it's looking at policies, it's looking at the economic environment at the moment. One that I really like is called the Washington Watch. Which Libby Cantrell.
Yeah.
So she's PIMCO's head of policy.
Yeah.
She's based out of New York.
Yeah.
And she puts out a blog post that is available. We'll put the link in the show notes.
Yeah.
And that is, people can subscribe. And that is, sometimes it's the frequency of that can be as frequent as the news cycle.
Yeah.
So during the election, for example, she was publishing that particular Washington Watch newsletter on a daily basis.
Mm-hmm.
Otherwise, it could be every 2 weeks if the news cycle suggests that it's not required. But it's really useful insight into the US political landscape. And right now, I'd say that's been a big driver of everything from an economic global economy perspective. So that's probably one.
Yep.
Another PIMCO one, it's a bit of a US focus, so please take this into account, but it is another podcast.
Yeah.
But it's the PIMCO Accrued Interest podcast.
Oh, yeah.
So the good thing with that one is it actually gives you some really good insights in terms of various people from a PIMCO, team perspective.
Mm-hmm.
They've had Dan Iverson, who runs our income fund, which is one of the largest managed funds in the world with over 300 billion US.
Wow.
Underneath that. It's a multi-sector bond fund. So, access to that in a really quick fashion in a podcast form, I'd say definitely that. Another one that I use generally is, obviously, I follow the Rask.
Yeah, thank you.
Bloomberg Trillions.
Yeah,
is
good
another
one.
one
Very
that I
good one.
like.
Yeah.
I probably prefer that because it's got an ETF tilt to it.
Yeah.
And it gives me some really good global insights.
Yeah, that's a great one. Yeah. I subscribed properly to Bloomberg the other day.
Okay.
Yeah, because I do read it a lot, and I was always one of those free users. But then I got the app, and it was only $2.99 for the first few months. And I thought to myself, well, this is the best source of information that I come across. And I watch it on YouTube every day. I was like, well, I might as well just pay up. It's about time I gave them some value because they've given me so much. But no, those are great. That when you stop and think about $300 billion in one fund, US, is bigger than the entire ETF market in Australia.
Yes. Yeah. When you put it in that context, exactly right. Yes.
Which is remarkable. Well, mate, we've covered a lot of ground, and hopefully this is kind of a definitive source for people that are looking for alternatives to hybrids, and just in general to help them understand the marketplace and what is possible right now in this market environment, which is fantastic. So I really do appreciate you taking the time out to join me.
No, thank you for having me.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel, or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.